I'm here with Philip Blumberg, who's the chairman of Blumberg Capital Partners, an investment management company based in the States. Mr. Blumberg, how did your investments fare the recession?
Well, it's a good question because, as you know, leading into this financial collapse was much too much leverage on the part of most industries, especially in the real estate industry. We've had a policy for the last 17 years of being low levered. So we were not affected by the debt crisis in this recession. More importantly, I think if you paid attention to the debt markets and the pricing markets, it was obvious that we were coming into a bubble. We began selling our properties in 2006. By 2008, the summer, we'd sold our last property, avoiding the financial collapse in October.
You must have been quite happy.
We were very happy. More importantly, our investors were very happy as we closed an open-end fund with a 15% average annual return. So I think we did very well given the circumstances.
Okay, I know your speciality is commercial real estate market, but could you just bring us up to speed with how the residential real estate market is in America at the moment?
Certainly be happy to. It's faring a little more uneven than the commercial market. Various locations are doing variously well. The New York market, the Washington market, even residential, San Francisco, some others are doing well. But many markets have still not hit recovery. We're seeing prices at best stabilize in many markets, in some cases still drop. Only markets like heavy capital intensive markets like New York and Washington are we seeing increases, significant increases in residential pricing. I think that's probably due to the fact that different markets went through more or less overbuilding, and the recovery in terms of this current recession is happening at an uneven pace as well.
Okay. We all know what happened with the subprime mortgages. How
Right.
easy is it to get credit now in America?
Well, I think it's not easy to get a lot of credit. It is relatively easy to refinance an existing mortgage where you've shown the ability, if you're in a residential market, to make payments. To go out and acquire additional properties without a lot of equity, I think is still difficult. And that's probably prudent on the part of the banks because they certainly are not in a position to get re-exposed to high-risk loans.
No. And now moving on to your expertise, the commercial real estate market, has this started to recover?
Yes, it has. Actually, our quasi-governing body, NACREIF, National Council of Real Estate Investment Fiduciaries, shows that we're now in the third quarter of a slow but steady recovery. We're seeing returns and price increases increasing at a rate about 4 to 6% right now. And it's expected that that pace will accelerate next year in 2011.
And what's the demand like?
Well, what we have is we have a cap on supply. There is absolutely no new supply coming online. In fact, there are in some cases reductions to supply. The consequence is that the market is faring through a 15 to 16% vacancy. That may sound like a strong vacancy, but in reality, most of our real estate recessions, we're talking about 20, 25% vacancy rates. So the market's relatively healthy, and with no new supply, we're seeing occupancy continue to increase and vacancy rates drop. We're also importantly seeing rents come back. Where rents had fallen back 15 to 18%, they're now in a market of strong recovery, and we're seeing rents at about the market we saw rents at in 2007.
Okay. Which regions in America are showing a strong recovery?
I think those regions that are diversified economies, financial services are showing strong recovery. They dipped the hardest, they're coming back the strongest. But we're also seeing recovery in markets like Texas where there was steady job growth. It's a diversified economic base, and the oil and gas industry there doesn't hurt either. In markets like Southern California, we're still seeing difficult recovery because it was overbuilt, it was over-levered, and it's still going through the throes of recovery. I think there are some areas, even in Southern California, like Orange County, which are good spots in a larger bad market. And I think that's how you have to look at the U.S. It's 40 large markets, each moving in a general direction together, but very different pace and very different schedule.
So what are your predictions for the real estate market over the next couple of years in America?
Well, irrespective as to people's thoughts about what's going to happen to the economy in America, it is clearly far stronger than that in Europe. And I have some very strong misgivings about Europe and about the government's manner of dealing with it, which is generally increased taxes, and we're seeing workforces resist austerity. In the U.S., you have no protests on austerity, and we're talking about tax reductions. Another difference is that the governments are at varying degrees of health. In the U.S., we're actually making money off our bank bailout, and even AIG will make money. In Europe, I think we're beginning to see a problem with regard to another double dip and a need for more capital into banks. And those are losing propositions right now. So when you ask me how I see the world faring, I think we're going to see capital flows strongly shift to the U.S. in terms of real estate, which bodes in 2011 and 12 for increasing pricing and a stronger recovery, primarily based on capital flows and a stabilizing real estate commercial market.
Okay.